Welcome, institutional stakeholders, to today's Explainer. We're rolling up our sleeves and unpacking Centene Corporation's incredibly strong first quarter 2026 outperformance. Right now, the managed care sector is navigating a pretty wild macroeconomic climate. We're talking turbulent post-pandemic Medicaid redeterminations, shifting Medicare Advantage regulations, and intense scrutiny on utilization. But honestly, despite all those headwinds, Centene is presenting a highly compelling narrative. We're going to look closely at their tangible margin recovery, a huge earnings beat, and, this is absolutely crucial, how strategic, localized community investments are acting as long-term medical cost management tools. It's a really fascinating look at the dual-engine approach of modern managed care and exactly how it translates to sustained shareholder value. Before we dive in, a quick, mandatory note: this video is for educational purposes and not financial advice. Okay, here is our roadmap for today. We'll start with Q1 2026 financial highlights, break down revenue and membership trends, analyze the health benefits ratio, explore the 2025 community health investments, and finally, check out Centene's updated 2026 outlook. Now, when we look at Centene as a Fortune 500 company, they've really established themselves as a powerhouse in government-sponsored and commercial healthcare programs. And their entire operational thesis, it relies on a uniquely local approach. They want to deliver integrated, cost-effective services. And that local focus isn't just corporate branding, right? It's a profound competitive moat. By decentralizing operations and building deep, localized provider networks, Centene gets better risk management, superior unit cost control, and way more agility when state-level regulations change. Keep that massive structural advantage in mind as we unpack the operational drivers today. Let's kick things off with Section 1. Q1 2026 financial highlights. So for the first quarter of 2026, Centene delivered an adjusted diluted earnings per share of $3.37. As CEO Sarah M. London pointed out, this was a massive beat. It came in about 50 cents better than internal expectations. Now, in the current regulatory environment, beating expectations by half a buck is a remarkably clear signal to analysts. It tells us management is executing flawlessly on their enterprise-wide margin recovery efforts. It shows disciplined pricing, spot-on medical trend forecasting, and a real ability to navigate the complex headwinds that have been hitting the broader sector all year. And beyond that impressive earnings beat, Centene is aggressively optimizing its capital structure. During the first quarter, the enterprise achieved a literal $1 billion debt reduction. They successfully utilized proceeds from selling a participating interest in 2025 Medicare Part D receivables to repurchase $1 billion of their par value senior notes due in 2027. It's a brilliant deleveraging move. It leaves them with absolutely zero borrowings on their $4 billion revolving credit facility at quarter end. For institutional investors trying to navigate the 2026 interest rate environment, having a pristine balance sheet like this provides a tremendous strategic advantage. A completely untapped $4 billion revolver offers massive flexibility, whether they want to look at opportunistic M&A, do some share repurchases, or just maintain a fortress-like defensive posture. Total revenue reached nearly $49.9 billion for the quarter, which just goes to show the vast scale of this enterprise. But if you're analyzing liquidity, the true takeaway here is the $4.4 billion in total cash flow provided by operations. This incredibly strong cash generation was primarily driven by net earnings and that strategic partial sale of CMS PDP receivables we just talked about. Monetizing those Medicare Part D receivables early accelerates cash flow and de-risks the balance sheet. It immediately converts accrued government obligations into liquid capital that can be reinvested right back into core operations or used to pay down debt. Moving right along to Section 2, Revenue and Membership Trends. Overall, premium and service revenues increased 5% year over year to $44.7 billion. But to really understand the operational drivers, we have to look at the specific mix. Medicaid revenues grew 6% to $23.5 billion, heavily driven by state-directed payments and vital rate increases designed to address underlying medical trends. These state-directed payments are an absolutely crucial piece of the puzzle because they help align provider incentives. Medicare experienced a huge 18% jump to $10.3 billion, fueled entirely by premium yield and massive membership growth in the prescription drug plan or PDP business. Meanwhile, commercial revenues dipped 6% to $9.5 billion. Now, don't let that drop fool you. This contraction is actually the result of strategic pricing discipline and an intentional footprint optimization. They are shedding unprofitable market share to protect their consolidated margins. That top-line revenue mix directly correlates with the total at-risk membership shifts. Centene's total at-risk membership is currently sitting at 26.2 million. We're seeing fully anticipated declines in Medicaid, dropping from 12.9 million to roughly 12.4 million year over year. This is the expected tail end of the nationwide Medicaid redetermination process, the unwinding where states resumed eligibility checks post-pandemic. The fact that Centene is absorbing this churn while simultaneously raising revenue guidance is a huge testament to their operational resilience. We also see a sharp drop in commercial membership from 6 million down to 4 million, which ties directly back to that strategic marketplace contraction. Balancing all this out is highly targeted, robust growth in the Medicare PDP segment, which swelled from 7.8 million to 8.7 million members due to highly competitive bid positioning. Up next, Section 3, Health Benefits Ratio Summary. Okay, the Health Benefits Ratio, or HBR, is literally the ultimate pulse check for profitability and underwriting discipline in managed care. Centene reported a consolidated HBR of 87.3% for the quarter. That's a slight improvement from 87.5% in the same period last year. An 87.3% consolidated HBR implies highly disciplined pricing and really accurate trend forecasting by management. Looking at the product breakdown, Medicaid HBR sits at 93.1%, Medicare is running exceptionally efficiently at 84.9%, and commercial is at 75.3%. Understanding the macroeconomic why behind these ratios is absolutely vital. That Medicaid HBR of 93.1% represents a 50 basis point decrease year over year. It reflects tangible progress in medical management initiatives, which, yes, was aided by a relatively moderate flu season. The Medicare segment drastically outperformed across both Medicare Advantage and the rapidly growing PDP line. However, the commercial HBR of 75.3% came in just slightly above expectations. Why? Higher acuity. Basically, sicker patients utilizing more services, specifically among Marketplace SilverCare members. But, importantly, management notes this elevated ratio is occurring prior to an anticipated risk adjustment benefit. Basically, higher acuity members trigger higher clinical risk scores. Later in 2026, those elevated risk scores will translate into retrospective risk adjustment revenue true-ups from CMS, which will effectively normalize this temporarily elevated commercial HBR. Pivoting over to Section 4, 2025 Community Health Investments. In modern managed care, philanthropic strategy isn't just corporate charity, it's a highly sophisticated, vital tool. It actively supports long-term medical cost management goals by addressing the core social determinants of health. In April, the Centene Foundation released its 2025 year-end report, highlighting an incredible $34.9 million in philanthropic investments. This funding was strategically distributed across 209 local nonprofit organizations spanning 29 states and the District of Columbia. They are directly targeting the foundational issues that drive up healthcare utilization and costs down the line. When we break down the allocation of these funds, Centene maintains a laser-sharp, localized focus. They directed $15.9 million toward direct healthcare initiatives, focusing heavily on maternal and child health to prevent high-cost NICU admissions. Another $14.3 million was allocated towards social services, specifically targeting integrated health and housing solutions. Education initiatives received $3.9 million, and $800,000 was dedicated to rapid response disaster relief, ensuring community stability during localized crises. To really grasp the institutional value here, we have to look at the long-term ROI of these specific programs. In North Carolina, Centene invested in the Northeast Winston-Salem Choice neighborhood to rebuild 244 affordable housing units. Stable housing drastically reduces transient emergency room utilization. In rural Kentucky, their WellCare subsidiary launched a Food is Medicine program, providing home-delivered, medically tailored meals to eligible Medicaid enrollees with diabetes. The clinical ROI here is profound. Proper nutrition directly lowers diabetic complication rates, significantly reducing expensive inpatient admissions, which, by the way, explicitly suppresses that Medicaid HBR we discussed earlier. And in Ohio, Buckeye Health Plan provided funding to help local clinics purchase ADA-compliant equipment, removing physical barriers so patients with disabilities can access preventative care before they require high-cost interventions. This scalable operational strategy is summarized perfectly by Joyce Larkin, the head of the Centene Foundation. She states, real lasting change starts with listening to communities and investing in the organizations closest to the challenges. By pairing financial support with strategic guidance, Centene's partner-first approach builds sustainable, localized healthcare infrastructure. This is definitely not just PR. It's a long-term investment in community health networks that will ultimately drive lower medical costs and higher quality metrics for the enterprise for decades to come. Finally, bringing it all together in Section 5, updated 2026 outlook. Thanks to these exceptionally strong first quarter results and disciplined cost management,
Centene is actually raising its full-year guidance. They increased the floor of their 2026 premium and service revenues by a full $1 billion. That brings the new range to between $171 billion and $175 billion. But most importantly for institutional stakeholders, they increased their 2026 adjusted diluted EPS guidance floor to greater than $3.40. You guys, in a highly volatile regulatory environment where many competitors are pulling back, raising a revenue floor by $1 billion and bumping up an EPS target is a massive flex. It signals to the market that management has profound visibility into their localized cost structures, robust pricing power, and absolute confidence in the long-term earnings capability of the enterprise.
We've seen the incredible strength of the numbers today, the 3.37 adjusted EPS beat, the $1 billion in debt reduction, and the flawless navigation of Medicaid redeterminations. But we've also seen the targeted millions invested directly into the social determinants of health to proactively control future medical costs. So, as Centene continues to bridge this tangible financial outperformance with profound community impact, how will this dual-engine approach reshape the future of localized managed care? It's the central question every analyst and institutional stakeholder must consider as we watch Centene redefine value in this space. Thank you so much for joining us for this Analyst Explainer. If you found this breakdown valuable, please be sure to like and subscribe for more videos.